Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets on a Friday. It's in fact the 2nd of October 2020. And what we want to do is we want to start to already prepare for the US election, upcoming US election in November. 1 second, let me just see. Okay, perfect. And we wanna start with the question if there's a way to profit from the US dollar rise and fall, or to put it a little differently, if there is somehow a chance to profit from the upcoming moves in the US dollar in general. So in general, what we want to do is we want to have a look at the price action in 2020 so far, and already give an idea on where the US dollar is potentially headed. And in fact, I can already say it, that it doesn't really matter if Biden wins or if Trump is re-elected. This is a fact. We want to have a look at statistics in a later webinar in the upcoming weeks then. In fact, there is a slightly positive expectancy for the upcoming 100 days after the election in the US dollar. If a Democrat wins, but in both cases, so in case of a Democratic win, it's a 4% move on average going back into the 1980s. In fact, in case of Trump being reelected and a Republican win, it would be a 2% performance in the US dollar. But this year could in fact be completely different. And this is exactly where we want to start today. And before we start, first of all, here, let's have a look at today's agenda. We want to have a look at, as I already said, the 2020 USD price action so far. I mean, has been a roller coaster, especially around the Corona lockdown. And what I want to give you an idea about is what happened there around the Corona peak. Some of you probably recall this. It's 6 months ago. And when we look at the US dollar, we saw a sharp rise, and then we saw a massive drop and continued weakness, in fact. So the last something like 3 weeks or so, 2 weeks, 3 weeks, saw some US dollar buying or short squeeze, probably a small recovery. But all in all, it has been kind of a roller coaster. And what we want to do is, in fact, we want to have a look here at the events around this Corona peak. And I give you an idea on what happened there, a deeper look behind the scenes, in fact. And then, what was the reaction, and where did the reaction in general come from? From the Fed with its massive ballooning of the Fed balance to nearly 7 trillion US dollars so far. So we started the year around 4.2 or something like that. The non-Corona, and I'm sorry, not Corona, non-QE was it? I'm sorry. The non-QE from September 19 onwards, with all these drying up liquidity in repo markets, for example, where the Fed had to step in to overcome this, let's call it technical issue. In fact, the technical issue, and getting rid of this technical issue, was by ballooning the Fed balance already to significantly back above 4 trillion, in fact. And beside that, we also have to have a look here at the US federal budget. And then, we want to answer the question, what does this mean for the US dollar? Where's the US dollar headed? How to profit from it? Is there a chance, or will the US dollar recover? It's probably a good way, a good idea to short the US dollar, respectively, to go long negatively correlated asset classes, especially precious metals like gold, like silver, for example, like Bitcoin, for example. And this is exactly what we want to look at today. And before here we start with all the content, that's me. So my name is Jens. I'm not sure, did I introduce myself? No. So my name is Jens. I'm located in Berlin, in Germany. This is probably the most interesting part. I'm in the financial industry now for nearly 20 years already. Started as an employee, a trainee with a bank, then worked my way through university, mathematics and economics. Beside that, I worked as a trading assistant at a big stockbroker here, learned to trade from scratch, a professional trading desk, in fact, and then made my way on my own after that. And started building my own business, respectively. Started, in fact, for a CFD FX broker before, worked there as a research a market analyst, built an education section for a big broker. In fact, back then, big broker. There was then the big hit with the S&B in 2015, which nearly washed this broker out of business. And shortly after, I started my own business after building something quite big here in Germany. And so why is Berlin especially important in this context? Because there is where Admiral Markets comes into play. Admiral Markets as a financial service provider in the industry now for 19 years, in fact, since 2001. So next year, that's the birthday, with 20 years in the industry, and offering over 8,000 financial instruments in 20 offices around, and more than that, offices around the globe, and licensed, regulated. And especially the part with having offices around the globe is noteworthy, because based on my personal experience, especially when it comes to retail business, and it doesn't really matter whether we look at CFD, FX trading, or if we look at equity trading, or if we look at a savings account, what I know based on my personal experience is that when it comes to financial questions, you usually want to talk to someone in your native language. And so having offices around the globe increases the likelihood of finding someone speaking your native language drastically, in fact. And so here in Germany, the office from Admiral is around 20-30 minutes away from my office, in fact. And if you do not have an office right around the corner, as I have in case of Admiral, you have a high likelihood, if you have any questions, to reach out to Admiral day and night, and find someone answering your questions, in fact, you might have. So definitely worth a look, giving Admiral Markets to give a deeper look, in fact, beside all the highly competitive offering when it comes to CFD FX trading, when it comes to stock offering, real multi-asset broker. So here in Germany, for example, we refer to Admiral as the DAX expert. So having the most competitive, potentially most competitive CFD offering when it comes to DAX trading. So admiralmarkets.com, give it a try, give it a look. There you can get all the information on Admiral. And we now want to have a look here at the US dollar. We want to have a look at the 2020 USD price action. And let's start here with the trade war escalation between the US and China. The USD index future, as you can read it here, traded around 100 points around, resulting out of fears that similar protective measures could be on the way, especially against Europe. And here in this case, it's noteworthy when we look at the US dollar index future as it's listed on the ICE in New York. The euro here has a weight of 58% in USD index. One thing is very important when it comes to trade wars in general. The measures being taken from the Trump administration and the tariffs which Trump brought on its way were mainly offset, in fact, by a devaluation of the currency which was affected here, like China, for example. So the Chinese yuan, for example, devalued massively against the US dollar, offsetting nearly all positive aspects you might expect, or Trump communicated as to be expected from these tariffs. And so if there's now speculation that these measures or these tariffs will also be introduced on, for example, European goods, then what happens is that market participants, respectively, the economy, the European economy, anticipates such a potential step from the Trump administration then, and starts to sell the euro, and that way try to offset potential negative impacts tariffs might have. So an increase in prices on European goods which are shipped to the US, for example, and offset that by a lower euro in this case, which means that you can afford more goods despite the tariffs being put on top on the price of whatever good we're talking about here. So that's what this paragraph is about here. And so then the black swan hit the Corona lockdown in the US, and we saw a sharp push higher, in fact, followed by an accelerating downtrend. And this is something I can already say it right here. The US dollar downtrend should continue. That's something I expect, in fact. And I also expect, for example, to make things quite straightforward here and already give you an idea. I also expect negatively correlated assets like gold, silver, but also Bitcoin to continue to appreciate against the US dollar. If you ask me, hey Jens, what do you prefer, gold or Bitcoin? I'm over 30 years old, so I consider myself to be quite old compared to the young guns out there, those who traded the Bitcoin main year, let's say in 2017, in their early 20s. So I'm a little, compared to these young guns, early 20 guys, I'm old. So I have 2 children. I'm a father. I'm married. I have a wife, and I have to take care of them. And that alone makes me conservative. If I look at me, so to some, I make a cool impression, let's say, and my a relationship and my private in the private world, I communicate and I move in and move out and that way. But the thing is that I'd already all the time prefer gold above Bitcoin, and that has, first of all, the conservative attachment to that, but also I think the independence from gold compared to Bitcoin. So if I buy, for example, 10 ounces of gold, I have them, I put them in my safe, and that's it. So it's here at home, let's put it that way, or I put it in the cellar, or I don't know. I have some other way to somehow store it, but I have direct access to that, and I don't need any kind of electricity or a laptop or something like that I need when we talk about Bitcoin. Beside that, there's also one aspect you shouldn't underestimate, in my personal opinion, and the older I get, the more conservative I get in this aspect. So probably you heard about this, but if not, I can say here in Germany, for example, there's more and more news now hitting the wire that there's talks about a high regulation when it comes to Bitcoin. Respectively, there's also talks about the potential prohibition of Bitcoin. So just imagine that. You're not allowed to take payments in Bitcoin anymore. So there might be small stores out there accepting Bitcoins, but just imagine these stores are not allowed to take Bitcoin payments anymore, or else they have to face, they will see draconic measures taken against them. So that potentially is negative for Bitcoin, and one of the reasons I prefer gold over Bitcoin. So just to make I'm sure that when I say Bitcoin could profit from a US dollar depreciation, I still prefer gold, in fact. And just to give you an answer here to the question, which potentially will come up in the upcoming minutes here, what do I prefer? If the US dollar keeps on depreciating, well, what do I expect to gain then compared to that? So negatively correlated gold, for example, silver also. And that's just to answer that question right here. But let's come back now to the price action in the US dollar in 2020. And there I prepared a chart to just give you an idea of what I just spoke about. So what did we see here? That was the appreciation of the US dollar, given the aspect, especially here, this drift higher from 2018. That's probably very important. By the way, here is the source, so it's barchart.com. This is also where you get here the information on the commitment of traders report, just to explain you what is this, what are these lines here. And now what you can see is from 2018 onwards, just remember in March, April, around that, there was the heating up in the tariff debate, respectively. The trade war started to escalate based on several tweets Donald Trump sent out back then. And what we saw was here this appreciation of the US dollar, continuously appreciating US dollar index future, for example, especially given the developments in the euro, for example. And then here you can see that was the trade war appreciation, and here was the so-called Corona peak. That was the peak. We shot extremely higher. We, in fact, short-term traded higher as the highs we marked shortly after the election from Donald Trump. What was the reason for that push higher here, especially? It had to do with the fact that market participants expected, besides a more restrictive approach from the Federal Reserve back then in 2016-17, there was also these increasing talks of fiscal stimulus, in fact, so tax reductions, which Trump brought up, in fact. And we shot into these highs from back then in 2016-17, and then from here we sold sharply off. And so far, the market has seen a small, or US dollar has seen a small recovery, but still the way is where US dollar is potentially headed lower. What I wanted to explain to you now is I wanted to explain to you what happened around the Corona peak to get an idea of where this sharp rise in the US dollar in fact came from. And the answer to that is a quite, technical one. It's the so-called reserve ratio. This is what delivers the answer and where this demand comes from and why the Fed especially ballooned its balance sheet and nearly flushed the markets with US dollar, and it should be expected to keep on flushing them with US dollars. So first of all, let me just introduce to you what is this reserve ratio. The reserve ratio is the percentage of a commercial bank's deposit that it must keep in cash as a reserve in case of a mass customer withdrawal. This is something what happened. You remember Corona hit. No one really knew what is this virus about. What will happen to my business, especially. So from an economic perspective, what will happen to my business? Can I keep on paying my bills? Can I afford whatever? So everyone ran to the bank and cashed in their chips and wanted to have as much cash as possible. In fact, that was also one of the reasons why, for example, gold dropped. So something you wouldn't really expect in a market environment where we face risk aversion. In fact, so you usually expect a safe haven like gold to appreciate in this market environment. Instead, gold dropped sharply lower. That was because market participants also sold their gold belongings, especially paper gold, in fact, to be liquid and to have enough cash available, not just to meet their margin requirements when it comes to equity positions, also equities sold off sharply, but also to make sure that they stay liquid enough to pay their bills and to fulfill the demand from creditors here in this aspect, in fact. So and here, now what we saw is, therefore, let's have a look at an example to get an idea on the reserve ratio here in this context. So let's imagine a sheikh, for example, okay? So, and this sheikh sells, let's say, oil for $1 million US. And now he takes this 1 million and he deposits this 1 million USD he just received at his bank in London. And then what the bank has to have in case of a reserve ratio of, let's say, 1 to 10, they only have to keep 10% of this 1 million in your account, and then they can loan 900K to a guy, let's say, who buys wood from a Russian, let's say, for example, from a Russian wood seller, which the Russian wood seller then deposits at his bank in Moscow. So this guy just bought for 900K USD wood, and now the Russian wood seller has 900K in his account. He goes to his bank in Moscow, let's say Sberbank or something like that, and then he puts these 900K into his account, and what you see is the bank having to deposit or keep 1/10 in of money in the account, 90K, and then loan out 810K. And this is happening over and over again and creates a bubble. Initially, there was only 1 million, and now you have nearly 2 million outstanding, in fact. And now what we do is we assume that the crisis hits, like the coronavirus, for example, and now the sheikh shows up at his bank in London, and then he says, hey, sorry guys, but I have to pay whatever invoices I'm getting here, or I have to pay my creditors. Please give me my million. And the bank is standing there not having the million available because they only have 100K. So what they then have to do is they have to find ways to get liquidity in this case, so US dollar, to pay out the sheikh. and get the money back, for example, from the guy who just bought the wood from the Russian wood seller, for example. So, but the sheikh wants his cash. He wants US dollar. He doesn't want wood or whatever. So the thing is that this is a very, very easy way to explain what happened in March when there was this US dollar shortage, in fact, and demand for US dollar shot through the roof, resulting in this massive US dollar funding shortage or squeeze in the US dollar higher, since USD denominated liabilities of non-US banks stand right now at 13.3 trillion US dollar. So put this number here into context, put this in relation to the balance sheet from the Fed. It's 1/3. So the Fed had a balance sheet at the beginning of the crisis, at the beginning of March, in fact, mid-February, of 4.5 trillion USD, in fact. So 4.5 multiplied with 3 delivers 3.3 trillion USD outstanding liabilities, USD denominated liabilities of non-US banks, in fact. That's one of the reasons why the news of cutting rates didn't got, or it wasn't that interesting. What was of higher interest at the beginning of April was that the Fed reinstalled so-called swap lines. Like you just imagine that. We look at the bank here in London. Let's assume that's Deutsche Bank, okay? So Deutsche Bank is mainly located, where the headquarters is in Frankfurt, Germany. Frankfurt, Germany has the ECB above. So what does the CEO of Deutsche does? He calls, let's just imagine that. That's a metaphor in this case. So he calls Christine Lagarde, says, hey, Christine, sorry, but we're running out of USD here. What about delivering USD? Call your guy in Washington, Fed Chairman Powell, make sure that he delivers as quickly as possible US dollar here to you, respectively, to the or from the ECB to our accounts, so that we can pay out the sheikh in London. Okay, so and this is what in fact happened when the Fed reinstalled these swap lines at the beginning of April. They said, well, you can get any amount you want from us in USD to make sure that this funding shortage does not result in a collapse of the complete system. So you might say right now, by the way, isn't that a Ponzi scheme we're running here? Yeah, our whole financial system is in fact a Ponzi scheme. That's exactly what happens here. So in the moment when you show up, or let's say there's 1 million sheikhs now showing up, they're 1 million euro USD, whatever back, especially USD, well, the system collapses because there's not enough USD available. That's classic for a Ponzi scheme, in fact. But now let's come back here to the Fed. The Fed still has a chance to overcome this issue. How? Well, they start printing USD. They flush the markets with USD as much as possible. They reinstall because they not installed them, but they reinstall them because they initially brought them up during the great financial crisis in 2008. They just had to reinstall them so that every liquidity issue can be overcome, in fact. So they were already prepared for this moment. And then what they do is they just print as many USD as they want, not only to deliver USD to non-US bank, but also to fund, in addition to that, the massive deficit in the US, which was introduced then from the US government, from the Trump administration, to stabilize the US economy. Therefore, let's have a look here at two charts. So first of all, I'm sorry, but you can see the source here. So it's tradingeconomics.com. You can look this up yourself on the website tradingeconomics.com. In addition to that, you will also see in the description box, if you now watch this, by the way, let me just write this down here, Fed balance, so I don't forget it. So trading economics here. So what you can see is it's the Fed balance going back till 2002, 2003, something like that. So you can see it here. It's around 1 trillion. And then they ballooned it. That was the great financial crisis. That was QE, that was QE2, that was Operation Twist, that was QE3. And then it stabilized here and they started to reduce the balance. And then here, that was what I refer to repo, the technical issues at the end of 2019, where liquidity in short-term funding markets dried up massively. And there was already here this ballooning of the Fed balance, and then it completely exploded during a Corona lockdown, in fact. So the Fed had nothing else in mind than to deliver as much USD as possible, in fact. And that's how this explosion can be explained. And by the way, we're not yet done. So right now, there's talks about, for example, a next Corona relief package. Just several minutes ago, non-farm payrolls were released, and you might say, well, look quite promising, no? So, for example, unemployment rate dropped to 7.9%, for example, still above the levels we have seen pre-Corona, but still in a dropping tendency, in fact. The only problem is that we still stuck more than 11 million jobs we lost then during February, March, in fact, during the Corona lockdown. And so all in all, what we should expect is that the massive deficit in the US alone and these new relief packages, they have to be somehow financed. And the Fed will finance them by just printing them away. Yeah, they're printing the debt the US government is right now loading up. They just print it away. And so expect here this balance to rather sooner than later exceed more than 10 trillion USD. Now, the thing about this is, and there's the next chart, and so this is the US federal budget to just get an idea of where we stand right now. So what we have here, this is, by the way, from a graphic, which is from Jerome Blokland. So if you're on Twitter, I highly recommend following this guy. It's really great content. You get there, great statistics, great charts. And what he shows here is he sees or looks at the federal surplus, respectively deficit, as percent of GDP. And what you can see here is that the current federal budget deficit, or the deficit the US government is running, sees currently the highest level since the World War II. Okay, so it's a complete explosion of debt, which has to be somehow financed in the current, especially during a time of potential economic downturn or a recession, potentially depression. And the Fed has no other choice than rather sooner or later print the debt away, which is usually always and all the time a positive sign for precious metals like gold, for example, but usually also for an asset, a very volatile asset like Bitcoin, for example. But I prefer gold above Bitcoin, even though I understand that many might say Bitcoin is probably better. Well, it's a fascinating, we had several webinars in this trading spotlight webinar series here on Bitcoin, in fact, and I as a mathematician, I mean, I have to just enjoy the elegance of the solution Bitcoin delivers here, and the blockchain technology. It's just great. It's awesome. It's really, to be honest, it's a fascinating concept. But still, it's something where I don't have full control over my asset in this case. So as I already said, if I have gold as a bar at home, it's at home. It's here. So I can touch it. I can feel it. In case of Bitcoin, I have to rely on the stability of the network I'm trading Bitcoin in, or I have to have electricity. So that's one of the reasons why I'm a little I'm skeptical here. But still, I understand the whole concept. Let's come back to the explosion of debt in the US. Let's have a look here at the Fed balance in this case. So what we can see is that there will be a debt explosion, and it has to be somehow financed. And the more USD you print, the more USD supply there is, while the demand after USD might potentially diminish, because there is, that's what the next slide brings us to then. the more USD you have, while there is not such demand or diminishing demand because of the Fed also losing the trust of market participants, the more it's all based on trust, in fact. And so the more the devaluation of the US dollar will take place, in fact. So that means for the US dollar, in fact, simply put, we should expect further USD weakness, in fact, since US yields are expected to go lower. And just have a look at the current 10-year US Treasury yields. You probably have seen that. Several weeks ago, months ago, we initially started, that was also brought up and potentially led to this parabolic rise in the gold price, but also in silver, for example. That was the speculation around potential yield curve control, YCC. That was the short version of that. And it was a topic at the July Fed meeting. It was also a question around the speech from Jay Powell in Jackson Hole, for example. It was also now a question whether it's brought up at the last September meeting of the Fed. And this yield curve control is like you're fixing, or you're pegging, in fact, that's not fixing, but it's pegging US yields to a certain level and not allow it to push higher, respectively lower, or only go lower from there. You don't allow it to rise. The thing is that you might say, well, is this possible? Is this manipulation of a currency, especially of yields then in this case, connected to this currency? Is that possible? Well, the Japanese are doing that now for years, and we haven't yet discussed it in depth, in fact. So some of you probably are not aware of that, but the Bank of Japan is currently pegging the 10-year Japanese yield, Japanese government bonds, JGBs, they're pegging the yield here at 0. And this is the same you expect then, for example, to happen rather sooner than later for the US yields to happen, in fact, that the Fed says, well, we're pegging here yields at 0. The only problem is that it massively undermines the question in regards to, let's say, the stability, or is the US dollar still a valuable or a haven you look for when you wonder yourself what will a post-corona world look like, and what currency will play an important role here. It's the world's reserve currency status in case of the US dollar. It's undermined if you behave that way. Some of you might say, well, why do we see in cases of risk aversion stronger demand for Japanese yen? The explanation for that is not because the Japanese yen is a safe haven, but because in times of, let's say, market participants behaving normal, or there's normal risk appetite, and they want to finance their speculation in rising equity prices, or rise in the US dollar, or rise in the euro, whatever, what they do is they finance in Japanese yen. They don't expect yields to rise in Japan because of the behavior of the Bank of Japan. So what they do is they sell Japanese yen, and therefore they buy equities priced in USD, for example. Just a simple example. If now markets crash, what you see is stronger demand for the JPY, but not because it's a safe haven, but because of the fact that markets are unwinding these carry trades. And that's a very important differentiation between safe haven status and like Swiss franc, where you also will wonder, well, is the safe haven status of the Swiss franc, for example, still given? When looking, for example, at this explosion of the SNB's balance sheet, for example. But now let's come back here to the question. What should we expect for the US dollar is further selling pressure, in fact. And this has mainly to do with something we call real yields. We'll see in the next slide a graphic for that. The thing is, let's come back here to the US dollar. What we now will see is a potential race to the bottom. So and that's one of the reasons why I refer to gold, respectively, to silver, but also to Bitcoin, for example. You might say, well, what conclusion can we draw out of this? Well, selling the US dollar. The problem is it's difficult to short the US dollar, since you are not shorting US dollar, but you short the US dollar against another currency. Let's assume it's the euro, for example. Then you have the problem that the euro finds itself in a very difficult spot too, which means like the ECB will rather sooner or later try everything to avoid a complete collapse of the European banking system. We're about to see that. It's just a question of time. The only reason we not yet have seen a complete implosion of the European banking system is because it's allowed to stay solvent, even though you might know that you're already insolvent, because your balance can still say this is money I can expect, or this is this is debt I can expect to get or being repaid. In fact, because and I, right now I assume that because this guy, this company, whatever I lent money to, was just negatively affected by the coronavirus. So and the European Banking Authority, the EBA, already said in March here in Europe that's allowed, or companies are allowed, or not companies, but banks are allowed to say, well, this is a debt you should expect to get repaid. And that's why, because you still expect this money to be repaid, the loan you just, the money you lent out there to be repaid, that's the only reason why you stay solvent from a technical perspective. So only from a balance perspective, but it's only possible because also, in addition to that, the ECB keeps printing money and flushing the markets with euro at their end. So taking this into account, you get to see this race to the bottom. So you have the US dollar, which will potentially trade lower, but not necessarily as dynamic as, for example, gold will shoot higher, because there's also the euro, which should be expected to drop in comparison to precious metals like gold, like silver, for example, because the ECB keeps on printing too, to make sure that the whole system is kept alive, in fact. And now we want to have a look here, this race to the bottom aspect, and look at it from a real yield perspective. And what we have here is data from the Fed, in fact, and also a chart which was then created by Jerome Blokland again. So what we have here is 10-year US yields in inflation indexed yield, inverted in it's turquoise blue, whatever, and you have gold in black. And what you can see here, just to make sure, what is real yield? So real yield is the yield you get if you have a 10-year US Treasury yield, let's say of 0.7% right now, and then you subtract inflation from it. And if inflation is, say, minus 2%, you have real yield of minus 1.3. It's 0.7 minus 2%, and then you get minus 1.3% real yield you have on your bond, 10-year US Treasury bond, for example. And since gold yields nothing, and this is all the time a point which is made by skeptics when it comes to gold. And then some people say, well, gold does not yield any money, and there's no dividend attached to gold. So why should I own gold? Well, because zero interest is still better than minus 0.3, minus 1.3%. That makes sense. And so that said, what we usually see is the more negative yield turns, real yield turns, the higher the gold price should be expected to rise, in fact. And so since we expect the Fed not just to peg US yields at the current level, but to drop, US yields to continue to drop, in fact, while inflation should be expected to rise. And some of you might have seen the developments in wheat prices and lumber, especially this parabolic rise. You can already spot inflation at several areas in the US, but also here in Germany. So I usually, what I do is, in fact, I refer to inflation when I buy beer, for example. So 6, 7 years ago, something like that, I paid for half a liter beer, I paid something like 80 cents or something. Right now, the price is 120. So I have 50% inflation in 6 years on half a liter of beer, German beer. I mean, it's great beer, no question about that, but still, it's 50% more than it was 5, 6, 7 years ago. So if you get data, for example, from Germany over the last days here, and pointing to deflationary tendencies. So we had a minus 0.2% inflation print on last Tuesday, year on year for September. And then that was explained by the reduction of VAT, so value added tax here in Germany. So we have usually 90% value added tax. It was reduced to 16% to overcome the potential a drop in demand, which results out of the Corona lockdown, and market participants, consumers, to become skeptical about the overall outlook, potentially also based on their situation when it comes to employment, for example, being fearful that they lose their jobs, or potentially lost their jobs. So what the German government thought was it's probably a good idea to reduce value-added tax by 3 percentage points from 19 to 16%. It's now a great explanation why there's a deflationary tendency in Europe, in Germany. But today, European CPIs showed the same tendency. And there, you can't really argue that this has to do with a reduction of value-added tax. So I'm not sure whether other countries did something similar in reducing value-added tax, but you can certainly not argue the same way, which means nothing more than there is a deflationary tendency, but it's a deflationary tendency you might see in goods which are of no high use, let's call it that way, for consumers in general, especially not during a crisis. So, but real yield in general, and to expect that real yield will turn even more negative is usually a very favorable environment for an asset class like gold, like silver, which yields nothing, but nothing is still better than have a negative a real yield of -2, -2.5, -3%, for example. So, and what I wanted to add here in this context is the more money you pump into the system, while there is no significant increase in the underlying goods, what you naturally see is a rise in price, which means rising inflation, which is naturally something which will turn real yields even more negative, especially in an environment in which 10-year yields, for example, in Germany already yield -0.6, I think, -0.7, and in the US we're still at an advantage here, 0.6, 0.7, but still we have an inflation which is significantly above 1%, which means negative real yields. So let's come to the summary. So to explain what happened during the Corona peak here in the US dollar, you have to look at the reserve ratio system, which caused the strong rise in the US dollar when the Corona panic hit in March, and there was a classic USD funding shortage, in fact. And since USD denominated liabilities of non-US banks stand currently at around 13.3 trillion USD, and the need to fund the massive deficits to stabilize the US economy, we should expect the Fed to continue to print more USD, to potentially even increase their current QE program rather sooner or later, flood markets with liquidity / US dollar, and keep on ballooning its balance sheet further, which I would say a good assumption here is to expect the ballooning to exceed 10 trillion USD rather sooner than later. And as a result, what we should usually see based on this aggressive buying, especially of bonds here, and the ballooning of the Fed balance, as a result, real US yields will continue to drop further, favoring not only continued USD weakness, but probably and especially also gold strength. But also in addition to that, again, from a speculative perspective, probably, especially when it comes to volatility, also Bitcoin here is definitely a haven you should have a deeper look at, even though I potentially, given my conservativeness, favor gold, in fact. And so that's it with the first webinar in regards to the US dollar. If you have questions, and I think this is I think it's a fascinating topic, yes, but it's also quite complex and complicated topic, and you probably have questions. Feel free to join our Traders Yard community here. The Trading Spotlight group is there for you. I'm there for you. If you have Okay, I'm sorry. I'm Dan. I just saw your mail. So I'm looking for the signal. Big movement till now. So from Dan. So on the downside, I don't have the S&P open, but Dan is also one of the guys from our trading spotlight community. So in the morning, I posted there a setup for the DAX on the short side. So if there's a move lower, then yeah, we are probably headed in a good direction here. Beside that, beside the trading setups, feel free to join our trading spotlight community for further questions on the topic here, on the US dollar shortage, probably on the outlook on Bitcoin, a comparison between gold and Bitcoin. So all discussions are more than welcome there. And beside that, next Monday, there will be the next webinar together with Paul, where he will talk to you about the current developments in the tech sector here and answer the question, are we in a tech stock bubble? And it will include here the stunning moves we've seen in US tech stocks. And the question, has it gone too far? Very interesting, by the way. So Amazon, for example, has its Prime Days now. It delayed it several times over the year due to Corona. And what we usually see, by the way, that's very short term, but still very interesting, in fact, is that usually Amazon performs well before the Prime Days. And then if now Paul comes to the conclusion that it's probably, from a risk-reward perspective, more interesting to consider short engagements, it's probably also something to consider then. And he will also define the tech stock bubble, what is the definition of it, and how do we turn it to our advantage. 2 p.m. London on Monday, 5th of October. And the inbox here with the webinar link will be sent to you directly. If you now watch this on YouTube, then please leave a thumb up here if you enjoyed what you saw. Share the video, comment, ask your questions, not just in the Trading Spotlight community, but also below the video. And if you want to register, ask your questions here right in the webinar, then head over to admiralmarkets.com. It's the education tab, and there you have the webinars and the Trading Spotlights tab, where you can then register for this webinar series. And there's the website, admiralmarkets.com. Here are the contact details. And as I said at the beginning, regulated broker. So that's why we have to have the risk disclaimer here. That's it from my end. So all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. I will look forward to your questions. Have a nice weekend. See you soon.